support that, but we'll probably still have the same conversation next year, and it's like, yeah, apparently we were wrong again. But
Well, it's kind of interesting you say that. So, by the way, I'm speaking with Doug Ramshaw. We're starting a minute early here. Doug is the president of Minera Alamos, MAI, on the Venture Exchange in Canada, gold exploration, gold mining company. Actually, they're a small scale producer, hopefully soon to be a larger scale one. It's interesting because you mentioned that the last few years, 2020 was a very good year, a very volatile year, but a very good year for the gold mining sector. 2021 was not as good a year. And in fact, now that we can look backwards, we can say that was the start of a cyclical bear market in early 2021. And then 2022 was a pretty god awful year. But actually, what's interesting is 2023, GDX is up 11% right now. So we've turned positive, but I know that is very different for micro cap juniors who are still largely in the red year to date, with a few exceptions. But yeah, let's start off the conversation, Doug, and let me ask you about this trend of M&A in the gold mining sector that we've seen in 2023. We had a big deal with Newmont and Newcrest earlier in the year, but recently we've had some mid-tier or even junior deals, Calibre and Marathon, Dundee and Osino now, just recently, B2 and Sabina. What are your thoughts on the M&A, activity in the gold mining sector and what we might see in 2024?
yeah, it's always good to see it. I think the biggest roadblock to kind of the smaller cap M&A is if you announce a deal. I mean, let's take it a step back. Everyone craves M&A, and then the deals get announced, and people are like, "No, not that one." Every team going into it. The Calibre Marathon Gold deal was a great deal for Calibre. I know Marathon Gold shareholders will feel like it was a take under. It's why it was a good deal for Calibre. Marathon had a additional cost overrun. They were going to get punished again on the equity side. Calibre solved that problem, and at the same time, with the money that they had, and at the same time, Calibre's issue of being a fantastic cash-generating miner, primarily Nicaragua focused, with a little bit in Nevada. Clearly, all those great efforts of producing money, which in this business we don't do enough of, were heavily discounted because of jurisdiction. So Marathon Gold, not only was it a good deal for them, they had the cash to support the final costs required for building out Valentine Lake and getting it up and running. It also diversified its jurisdictional risk. So great deal for Calibre. The other deals you mentioned, again, they weren't really cash required. I think we all want to see M&A, but if you were to announce a deal now and a small cap kind of merger or whatever, and even examples that have been done where there was money alongside it, you're going to get punished with the day one settle. If there's any kind of premium, you take that punishment. Calibre knew that they were going to have a day one settle, a week one settle, probably a month and 3 month settle, which was at a discount to where they were trading beforehand. But you got to admire the vision of saying, we don't really care about that, and our shareholders shouldn't care about that either. It will work itself out as the arb comes off, and we move this forward. But a lot of deals probably should be done right now to kind of consolidate the sector. The lack of cash flows into money flow into mining is problematic. It's problematic for companies being able to raise money It's problematic just from the perspective of generalist investors looking and going, it's not, the market's not primed yet. I mean, when the bellwether stocks have kind of round tripped, they bounced a little bit, but a month ago, a company like Agnico, fantastic miner, elevated itself right at, chomping at the heels of Barrick, with a couple of big deals. But up until a few months ago, it effectively round tripped, since 2019, despite these high gold prices. So, we're seeing in non-US dollar terms, record gold prices, Aussies printing cash or printing more cash potentially than their US counterparts. But the problem is when we look cyclically at the top and with the rising operating costs and cost curve in this space, it doesn't encourage the money inflows, which will support a lot of M&A business. So we're seeing some green shoots right now, and I do think that the gold market's going to improve in 2024. But take that with a pinch of salt, because I did think 2023 set up better, but 2024, I think the stars are aligning for gold, which probably means it will disappoint us again, because that's just what gold does. These are healthy gold prices, but we've still kind of got some sickly margin contraction to work through the system. So that good market of 2020 you're talking about was really the only positive margin expansion we'd seen in the space, and really the only decent market we've had in the last four or 5 years was a 4.5 month window from May to September in 2020, and it's been death by 1,000 cuts for 3 years since. So next year, if we can see new all-time highs and we can start seeing some margin expansion, can we see some money flow coming into the sector that can buoy a lot more boats? Yeah, I think we can, and that probably will support more M&A as well.
Yeah, man, I feel like I could ask you so many questions. I want to try to keep this conversation as organized as possible. So let's lead on to that. 2024 margin expansion potential in the gold mining sector after 3 years of vicious contraction since that sort of peak that we had in August, September of 2020. So I'm looking at the gold futures right now. We're at 2,067 an ounce on the February contract. As you said, that is a healthy gold price. And, except for that little Sunday night futures move we had a few weeks ago, that when it hit 2152, basically 2067 is a stone's throw. I mean, it's a step away from an all-time high. What are your thoughts on the cost pressures in the gold mining sector? We've had 3 brutal years that has really killed the sentiment, among investors. I mean, every time we see Newmont put out a quarterly report, or even Barrick or, Agnico, Kinross, we just see costs going up, and definitely the smaller miners have been feeling the cost because they don't have the scale to spread it out as much. Is there some optimism here that maybe we've sort of reached peak costs for the time being, and we could see some stabilization?
Yeah, I mean, the interesting thing will be in a rising gold market, you actually expect the cost curve to increase, and not through some of the factors that have impacted this. I mean, since gold took off, I mean, the reality is we've seen cost inflation hit on energy costs, on manpower. A lot of those aren't going away. But if those costs stabilize and gold starts taking off, and say it goes to $2,300 or $2,400 an ounce, you actually still expect the industry cost curve to increase. And it probably, in most operations, it should, because you will change your cutoffs, and you will play a delta on it. You'll produce more gold at higher costs, but actually play that delta change in cash flows. So you should see, to some extent, the cost curve rise with a rising gold price. The overall profitability of the company should improve. But it's not because, they're now producing, producing their $1,400 gold at $2,400 an ounce and making $1,000 margin. They're producing more gold at less of a margin at those same prices, and so you should see an increase. I mean, this is a thematic conversation about a lot of things, but I'll say from Minera's point of view on open heap leach projects, the mine we plan to build next year has all-in sustaining costs, life of mine of $873, and at a $1,600 gold price. But Darren, our mine builder, will say, look, if gold's 1,800 or 2,000, that project will run probably closer to 1,000 ASIC, because he's going to play with the cutoff. So, that's a conscious decision to have an impact on your costs and actually be more overall group-wide profitable from it, as opposed to some of the costs that have obviously had this deleterious impact on the industry cost curve, that we've seen and haven't worked themselves through the system. So, but I do think that enough of those costs are sticky that we need to see a rising gold price to see meaningful margin expansion again, which is going to see the money flows coming in. I mean, if you look at 2020, traditionally margins, great chart that Ron Stewart, former Claris analyst, posted on LinkedIn the other day, which shows the 5-year quarterly operating margin of, I don't think I can share pictures, or can I on this thing? I don't know.
You can just tweet it.
I can tweet it.
You can just tweet it. Yeah.
Okay. I will tweet it, but really, traditionally these operating margins over the last 5 years, going back to the first quarter of 2019, are typically between 30% on the low end, which we saw in the middle of last year, to high 30s. And when we had that torquey market in 2020, we saw those margins break out to kind of 48 and 46% before settling back down again. And that was where we were seeing all these headlines about record free cash flow. Well, we haven't seen those headlines for a long time. Those are the kinds of headlines. Money inflow coming into this space. Sorry if you can pick up the yappy dogs in the background, but so yeah. I'll go speak Rob just for a second so that you can.
Okay, it's interesting. I'm not sure everybody who's listening may have fully understood some of what you said there. The all-in sustaining cost of Santana or Cerro de Oro, 873 per ounce. But if gold is 2,000, you expect the all-in sustaining cost to tick up to closer to $1,000 an ounce. And the reason for that is because you would mine lower grade ore, maybe with a higher strip ratio. Is that essentially the point that you're making, that a higher gold price has you mine a lower average grade?
Yeah, you drop your cutoff, and grade's gonna drop, but you're gonna be producing more gold and that more gold at a stable margin to what you'd be producing less gold with lower ASIC in a lower gold price environment. Your margin on the ounces you're producing might not change, but your cost, but you're actually producing more of that whatever $600 margin, $800 margin gold. So your profitability increases, but your cost curve has actually gone up, and that's all right. That's okay. And there are operations where you can throttle the cutoff grade. Open pit heap leach is a good example of that.
Okay. I want to ask you, because the last time we had this conversation last year at this time, we talked about the Kinross acquisition of Great Bear, something that you know intimately because you were a board member of Great Bear and a pretty sizable shareholder. What are you hearing? So basically, Kinross, if you look at the Kinross chart on the NYSE KGC, Kinross Gold, it's back to 622 a share. So basically back to the levels it was trading at right around the time that it announced that proposed acquisition of Great Bear that eventually went through. And it's interesting because in November 2021 was a major peak in the Kinross share price. Probably no accident, because that was a pretty big acquisition for them. What are you hearing, if you're hearing anything about Kinross in terms of the acquisition, how they're advancing the Great Bear project there, and how they feel about it?
They're up. It was $7.46. They were at the time Canadian, so they're up about 10% from the price they were when they announced that deal. And going back to my earlier comment about M&A, I'm incredibly biased because I was a big beneficiary of that takeout, but the jury is going to be out on that on that acquisition for a decade plus. But I personally think 3 decades from now they'll still be producing hundreds of thousands of ounces of gold from the underground component of LP. Now, at the time when we did the deal, there was a big reason why we added a big cash component to it, which normally, and I feel really bad for Paul and the Kinross team there, because they were just dealt with such a black swan of Ukraine. At the time of that deal, I think the analyst forecast had them spitting out close to $1 billion of free cash for the next 3 years. But a big component of that was their Russian operations, and then those obviously they were forcibly sold at an absolute fraction of what their worth was. And so not only are they, being hit by, the market hates M&A, so you've got to settle on the stock straight away. And now they get the double whammy of Ukraine. And I'm glad that they're coming through it. I think Kinross is the ultimate, kind of talky, higher cost gold producer, although I think they've rationalized their operations very nicely. And now they've got some good, less crazy jurisdictional diversification that they had. And so I think their jurisdictional profile has improved. Gold prices have obviously helped them. And I'm not sure where Kinross would be now if gold was at $1,700, but they'll be a big beneficiary of this move. And as for LP, like the deepest Dixie, or the main deposit they were buying it for, the LP zone, the deepest that Great Bear ever drilled, we drilled a couple of deep holes they intersected LP at about 800 meters vertical depth, and we were still hitting this high grade, high strain zone that our geos referred to as the plywood, because it was so predictable. It was just there. Wherever you drilled, it was there. And I remember at the BMO show earlier in the year, Kinross had just drilled and announced a hole at 1,300 meters of vertical depth on the LP fault. It wasn't one of 10 they drilled down there. They put a hole down there, and they hit 10 meters of 10 grams. They've subsequently drilled at, I think, 1,500 meters vertical depth on the LP and hit a couple of meters of 250 odd grams. This thing it's a remarkable deposit. They will be served very well from it, especially given the underground mining widths. I think some people were disappointed, and we always knew on the Great Bear side there were such crazy expectations of what initial resource statements were going to be there. There's no way the project could live up to some of those retail expectations in its first iteration of its resource, or probably in the first 4 iterations. But the gold was clearly there. It's just a function of being able to drill it out. What's interesting about LP is historically, I mean, 2 things, I guess. There is no open pit in Red Lake. So it's been known as this high-grade capital of the world. There is an open pit that sits under the town of Red Lake, so it will never get mined, a few million ounces. So, but in reality, LP was this real weird anomaly that there was this unbelievable open pit there, and then you're going to mine it thereafter as more of a classic underground Red Lake mine. Now, the historical production out of Red Lake, which is probably north of 40 million ounces, has come from an average grade of about 12 grams over an average mining width of about 2 meters. And what was interesting about the resource, the underground resource component of their maiden resource was, I think they had a grade of around 6.5 grams, but an underground mining width of 6 meters, which means you can employ a lot of different approaches to that underground mine development. And the one thing that you're never going to be short of is the tons per vertical meter to feed the open pit mill that they'll size the open pit around. Some bright spot will make a few dollars writing a book about that deposit, like they did some of the other great, like Hemlo, the Golden Giant. There's a book, I've got on my shelf behind me. I mean, Dixie, I think, will be no different in years to come.
Yeah, I think you said that's very interesting. It reminds me of Pure Gold's motto that Red Lake is Canada's Fort Knox. Unfortunately for them, they weren't able to unlock Canada's Fort Knox, but Red Lake is Canada's Fort Knox with that open pit, basically gold deposit that sits under the town of Red Lake. That's pretty incredible to think about it. Basically, the town is made of gold. So that's very interesting that they drilled 1,500-meter hole and they hit 100+ grams per ton gold over a couple of meters. So the grades in some areas are getting better at depth. And you're right. I mean, 6 meters wide for underground. That's just at those grades. That's fantastic. That's truly world class.
Yeah, that was the average width. I mean, you got to remember this. The heart of the LP. What will be the heart of? I'm gonna guess the LP underground is 2.5+ kilometers. And there's scope outside of that, but it's a remarkable deposit. I'm very lucky to have been involved with it.
Yes, you were lucky, and it truly is, incredible story, and there will be books written about it. So let's move on. So I want to talk about the company that you're president of right now, MAI, and the stock was about 75 cents or so for a period of time.
About a week. No.
Okay. Well, I'm looking at the chart right now, Doug, and in 2021 you were trading above 70 cents for a couple of months, and then in 2022 you hit 75 cents for about a week. But so you're 34 cents here today. Market cap's about 150 million Canadian. I'm not going to put words in your mouth, but just from sort of a passive, observer of the sector and of the company for many years. Basically, the company has been hindered by slower timelines on a few different things. So my first question for you is, what have you learned from 2023 and some of the challenges that you face? And then the follow-up to that would be, do you think the challenges are in the rear view and things are really going to turn around in 2024?
I wouldn't be doing my job right if I didn't say yes to the second question, but I think it's intellectually dishonest without having a background to that. So, yeah, we had some challenges. I've always said, like, the Minera model on one, which like everything else in 2020, 2021, everything got ahead of itself. I don't want to use comparisons. It's relative performance or anything like that. But I rarely get into talking about the stock price action itself. But I was having this conversation with a big shareholder one time, and he was talking about the stock price. I said, look, the way I see it, north of 60 cents was kind of that blow off top that lots of companies had. I mean, Agnico was up at $105 an ounce, $105 a share. We all had it. It was great at the time, but you also suffer the hangover from that. Now, 60 cents down to 40, I think is as a direct result of some of those things which slowed down a kind of running on rails, things are great type approach. And then 40 to 30 was kind of just following money flow in the space. And the good thing about that in many ways is I feel like that 20-cent fall from 60 to 40 is recoverable regardless of what happens in the gold space by just us turning things around. That actually gives me a lot of comfort because I think we have the team to do exactly that. And especially because this was not a project that had issues because, oh, wow, suddenly we discovered metallurgical issues, or they were, we built the first mine and it was just meant to be a starter mine, very low cost, 10 million capex build to really get things up and running. So the second mine we could take some debt on to build. Again, a low capex build, but still, you don't want to be taking debt on for your first one. And we were then hit with a pandemic right when we were going to build. And that didn't stop us. We built it. It was 6 months behind schedule, but it was on budget despite the pandemic, about 10 million bucks. Then we got hit with a 3-year drought, a really significant one in northern Mexico, southern California. We all saw the pictures of Lake Mead drying up. And so I do, and then following, like, this mine was permitted by the AMLO government. Now, there's a lot of noise about AMLO and mining in Mexico, but despite some of the things said, a lot of them don't hold water when you actually look at the evidence, including, he's made statements like his government hadn't awarded any mining permits, and yet all Silvercrest and Minera all received them from AMLO. In fact, in the early days of the AMLO government, things were moving very, very fast. We got the Santana, the second part of our permit, way quicker than we were expecting. That was from the AMLO government. So it was like, oh, this is good. This year, 2023, reminds me of what the Queen Elizabeth said about 1997. It was the year that Princess Diana died and Windsor Castle had a fire, and she called it her Annus Horribilis. And it really does feel like that. And it's been torturous for our shareholders. And trust me, it's been torturous for us from a company perspective as well, because the water is not an issue now. The pandemic's not an issue now. We've been waiting for about 6 months for a simple amendment to a permit that would allow the efficient development of Santana. We could have listened to the market and given them what they wanted, which was some rising production rates, and we would have created inefficiencies for us moving forward. And I respect our team down there to say, no, we should stay the course, get this permit amendment, and not push off a problem, create a problem for us down the road. We'll just bite the bullet, and in the meantime, do what was most important, which was protect the balance sheet. which we built up in 2022 and allowed us to make these, I think, correct corporate decisions in 2023. It's tested the resolve and patience of our shareholders, and trust me, waiting 6 months on this permit amendment, which we feel we're optimistic is very close. And that's the reason I think 2024 is going to be a better year for us. But I think my greatest chagrin for 2023, honestly, Robert, is if that had come, we'd have been, despite the recent move in gold, we would have been a strong outperformer this year, as opposed to for the last 6 months. The damage was done in the first 4 or 5 months of the year, and then for the last 6 months, we've really just tracked money flow in the sector. That's not like just tracking, relatively the GDXJ is not, something I've ever wanted to be, hang my hat on. When you're trying to attract investors into your company, into what I think is still a very smart business model with these low capital intensity mines, just tracking the GDXJ. The GDXJ is a horrible, that's a passive investor type, vehicle anyway. I mean, you want to attract investors who see that you can outperform your peer group. And we could have done that this year, I think, if things had come along in a timely manner. So I struggle at times to think what we could have done to mitigate that. Unfortunately, when it comes to that permit amendment, it is largely outside of our hands. So, I always want to look inwardly and say, what could we have done better? I actually think we could have done a lot of things worse. That's the way I look at it. It's like we could have listened to the market, tried to deliver what we thought would give them some short-term satisfaction, and probably blown a giant hole in our balance sheet in the process, and that would have given them far more reason to be upset with us. So, could we have done things worse this year? We absolutely could have done. Could we have done certain things better? It was very hard to predict. Suddenly, this rapid kind of slowdown on things. And the thing about Mexico is it is a good jurisdiction. Some of these headlines have made it sound like it's going to become Venezuela, and it's not. Mexico, probably 4 or 5% of GDP is mining, employs 500,000 people. It's a storied industry going back through history in Mexico. And the AMLO government is making more money from mining than any previous administration. I mean, I personally think that if I'm going into an election, whether you think you have it in the bag or not, you extol the positives about what your party has done. And so I would expect him to, to actually maybe not fully walk back everything he said, but walk back aspects of it. And we're seeing that with some of these permit amendments. I believe all has got the big pushback amendment that they required for Camino Rojo in Zacatecas. You saw recently, we had a pop on our stock the day that Torex Gold got their permit amendment for in-pit tailings disposal, because rumors were circulating at the Denver and Beaver Creek gold shows that there were a number of permits and permit amendments that are going to come through by year end. And we certainly started to see that. And are we there waiting to take the pitch, or are we in the batter's circle waiting to go up to the deck? It wouldn't be me if I didn't bring in some kind of sporting analogy. And I think we're on deck. We're optimistic, and we're planning for it, and we have the funding for it. And it will allow us to get back to being a truly cash flow, cash generating business next year, just with Santana. And it should then also dispel concerns people have about Cerro de Oro's permitting. And, it's an open pit, and people think, oh no, open pits are going to be banned in Mexico, which is just not going to be the case. Those articles that people might read from time to time, typically out of BN Americas and Mexico Business, not in the mainstream media. The projects that they talk about routinely in there were the problem children of previous administrations as well. They're in environmentally sensitive areas or areas with very poor water availability or heavy indigenous populations. This is not an AMLO edict. It's an edict for responsible mine development that was in place before AMLO. And so for responsible open pit mine development in areas where there aren't water issues and there aren't indigenous people and there aren't major environmental concerns, should be no concerns about open pit mine development. The mining unions that are big supporters of AMLO are not going to want to see an end to their livelihood in open pit operations in Mexico. Agnico invested into Teck's San Nicolas project a little over a year ago, which is going to be a giant open pit. So companies that understand Mexico understand, that the reality is there is no open pit mining ban in Mexico. And to make that point, I think, as crystal clear, when Mexico put forward a mining reform last year, or earlier this year, I should say. I know I'm already jumping ahead to being in 2024, but there were a lot of really good things in that mining reform, things I have no issue with. I actually think the reform as it stands right now, which is under heavy legal challenge for the unconstitutional nature of how it was driven forward, actually is more problematic for explorers down there than it is producers. But at no place in that mining reform you're overhauling your mining industry. You've had statements or misstatements about open pit mines, no more of those. And yet in not one place in that mining reform was there a little bullet point that said, oh, and by the way, no more holes in the ground. It's so unfortunate. I think in time you will see a lot of those comments walked back to more like, well, obviously we're not talking about all open pits. Mexico is a country of miners. It's a country that benefits greatly from the mining industry, but we are very much in favor of responsible mine development and protecting our local communities. So in areas where an open pit would be problematic, those ones are likely not going to get permitted. What we haven't seen in Mexico is what we saw in Chile earlier in the year, where there were 5 back-to-back permit denials. I'm glad to see, and that was very political. And with Rio 2 this week, we're seeing those walk back now. I think you'll see a lot of walking back of some of this language in time on a broad open pit mining ban, which just doesn't exist. The problem has been no one has had a project on deck to kind of prove or disprove that theory, since of any size, since Orla's Camino Rojo.
So with Cerro de Oro, one of your key accomplishments about a year ago was publishing the PEA for Cerro de Oro. And I'll just throw out some key highlights from the PEA. After-tax NPV of US 151 million, after-tax IRR 111%, pre-production capex of US 28 million, average annual production of 58,400 ounces per year. And this is all using a US $1,600 an ounce gold price. So the economics are likely to be quite a bit better at a $2,060 an ounce gold price. I think there's a trend in the mining sector, especially the last couple of years, when we've seen all these costs, these big cost, overruns, is that investors don't think these PEA numbers are real anymore. What would you say to somebody who says, well, that those aren't right because the market is not valuing you there?
No, I think Joe Mazumdar of Exploration Insights says it better than most people, that a project never looks as good as it does in a PEA. But that being said, our PEA costs were informed not from some peer group, database of stuff. They were informed by our development costs of the Santana mine. That was just a year before. that the capex is 28 million, but that includes a 30% contingency. So the capex was 22, and I'm very comfortable with our capex cost, because people thought we couldn't build Santana for $10 million, and we did. The problems with Santana are nothing to do with that capex build. So I think the secret here, and a banker at CIBC told me a year and a half ago, he said, so what are your next two projects total capex? And this was talking about La Fortuna that's waiting in the wings with permits, and Cerro de Oro. He goes, what, about 60 million bucks? And I go, yeah, give or take about 60. So he goes, and this was a time where we were seeing big capex blowouts at Argonaut and anticipated ones at Marathon Gold as examples. So he goes, so if you saw a 30% increase in capex combined over your next two mines, it's 20 million bucks. And I go, yes, it's annoying, but it doesn't create some major funding shortfall, especially if you've got the first operation up and running and developing. And I noted with Marathon Gold's first cost increase, which came out right before Beaver Creek in 2022, that we could build 5 Cerro de Oros for their cost overrun, not their capex. So I think whilst we're not completely immune from inflationary pressures, we are incredibly insulated. And this is where I get back to, sometimes things have dragged a little bit, and quite a bit in some areas. Some by design. We took longer to do our surface rights agreements for Cerro de Oro, so that we would not only be permitting for the base case PEA that you highlighted, the kind of eight years at 60,000 ounces a year, but a very visible upside case that we believe exists there, we're permitting for right now. Twice the pad capacity of the initial model. It's probably more like an 11 to 12 year life of 90,000 ounces a year. And we made a conscious decision to take our time on that, so that we could permit everything that we would want right from the outset. Now, in reality, some things take a little longer than we would have liked. But I say in many ways, I will always take time. Time doesn't have the same cost. Yes, it tests and costs the patience of some of the most loyal shareholders a company could want to have. We are very lucky in that regard, and they've deserved a better fate over the last year and a half. But time doesn't have the same cost as cost overruns. Someone pointed out recently that Argonaut Gold's share count, which is now over 1 billion shares, has gone up 7-fold in the last 10 years. Now, think from an investor point of view, what that does to you. I'm quite proud of the fact when we merged Minera and Corex in early part of 2018. We didn't do any financing at the time, so we did a finance. So it's 250 million share companies we slammed together, didn't roll it back or anything. So 300 million shares out. And a year later, we did a $5 million raise at 10 cents a share, 50 million shares, no warrants. We hadn't had warrants on the books for 4 years. Always proud of doing strong financings that are warrant free. So maybe you could say post-merger and post the first financing, that was where we stood at, 350 million shares in March 2019. So we're closer to 5 than 4 years after that, and our share count has gone up 30%. About 30% in 4.5 years, whilst building funding and building one mine, picking up something else, getting it into permitting, studies, everything that comes with running a company. 30% dilution over 4.5 years. And I hope we've largely seen dilution behind us, but I'll take that every time over a 7-fold increase in shares outstanding. And I think one of the things about our business model is, there's risks in mining. Absolutely. There's risks, there's time delays that have a cost, but my God, our business model I always thought was smart. This low capital intensity. We build mines cheaper than anyone else will. And I think what that means is when they're up and running and producing cash, we haven't got years and years of paying that debt that's got incurred and cost overruns and just making up for that dilution. The benefits of it will come through in spades. Right? So that's why I think that there's a much brighter future ahead than obviously a 2023. I think everyone involved with Minera, shareholders and management alike, would like to have in the rearview mirror as quickly as possible.
All right. Well, it's going to be in the rearview mirror in 9 days. I do want to open up the floor if anybody has a question for Doug. I've got two more questions for him, but if you have a question, please raise your hand and I'll activate your speaker mic. So switching gears a little bit, Doug, you've been on Twitter, formerly Twitter, now X, I think for at least 5 years. I recall you back in the 2018 timeframe. How has it evolved in your estimation over the last few years? I've noticed some things, but I want to hear what your thoughts are. And also, who are some of your favorite accounts to follow?
March 2009. But I was only using it to help it was a news aggregator for me initially. So it was really only in 2018, I suddenly, I'd been told I was a good mining follower and I didn't really understand that because I was having some fun. I was letting my natural personality come out. There was less mining information and more silly GIFs that summarized what I thought of about a mining situation rather than in-depth knowledge. But it's been like on a personal level, it's been amazing. I've met some truly fantastic people. There's a MinTwit crowd that are exceptional. On a company level, I'd argue that probably 10% of our shares at least are owned by people that are on Twitter. That hasn't cost the company anything. And anytime you can market and establish that kind of shareholder, and it hasn't cost the company anything, that's money that can go into driving the business forward. So it's been amazing. I put myself out there and I'm available. I deal with the slings and arrows from a few people, and I'm happy when I'm able to turn their way around. But what makes a market is dissenting opinions, and so it's been good. In terms of Twitter, or now X, if you want to delve into Twitter, you can see the best and worst of humanity. I just don't do those delves. I don't get drawn into conversations that I think are the kinds of ones which you're told you shouldn't have over Thanksgiving dinner type conversations. I just try to keep it real on Twitter and realize it is a personal account, but I'm also representing not just my company, but the industry at large. But I still find it an invaluable source of communication and conversation. And as investors, it is hard. This sector is a minefield of people trying to do really good work, and a lot of people taking advantage of this sector for their own self-interest. And it's hard to navigate that. And I see the good and bad of mining on Twitter on a daily basis. But it's no different. It's a good and bad of mining on, if you just were going to a site and looking at the press releases on a given day of what comes out of this sector. It's I just have a personal belief that our sector does do a lot of good things, but it does do a lot of things badly. And even though it might not have felt like it for Minera shareholders over the last year and a bit, the the essence of what we're trying to do at Minera is to do things the right way, for the right reasons, correctly aligned with our shareholders, and build something that not only we're proud of, but they are vindicated and proud of being shareholders of, right up until the time they're not, because there's will be a time in the future where they can bank their profits again, and you should in this space. But I know as someone that will be a lifer in this sector, we're trying to build a company here that will be around 20 years from now, doing bigger and better things all the way along. And, it doesn't matter if you're an exploration discovery story like Philo that was 10 years in the making, or an unbelievable outperformer like John McCluskey's Alamos Gold over the last couple of years that, was 20 years in the making through doing things smartly, rightly, and had its problems along the way as well. But I mean, Alamos started out as 5 or 6 of them in the basement of John's house, and it was a small producer, and it had major recovery issues early on, and but perseverance and good teams and good deposits that allow for good businesses to be built from can stand the test of time. There's such a short-termism. I mean, you kind of see it on Twitter to some extent. With there are a lot of traders on Twitter,
Yeah.
rather than investors.
Yep.
And it's like hey, if that's what you want to be as a trader. Mining sector offers great trading opportunities. I've never been a trader, so I think of it from an investor perspective, and there are a lot of really good mining investors as well on Twitter, and so it's like everything, you just get the broad spectrum.
Yeah. When I hear you say that, what really strikes me and what makes you different is that you are in it for the long term, and you care a lot about the long-term vision and the legacy that you leave, both for yourself, for the company, and for the mining industry. And that kind of thinking is refreshing, and I think that we could use more of that, because there are a lot of people who are in it for something else, short-term gains, but personal gains, not necessarily for the shareholders as a whole. I want to ask you, and again, I want to open the floor to another question, but I'm going to ask you one more here, and then we'll take questions from the audience. Who are some of the top younger CEOs in the sector? So when I say younger, let's say under 40, up and coming guys that have caught your attention and you think they're really standing out above the crowd.
Yeah, I recently had a shock. I was in a Denny's for a brunch, and I realized I'm 3 years away from being able to get the 55-year-old plus Denny's special. Again, I said 2023 has been a tough year. That's up there. And yet I consider myself pretty young in this space. So there are people doing fantastic work like Zach Flood at Knorrland, just knocking it out the park with that, and realizing that exploration has a tremendous cost, and you can avoid a lot of that cost by occasionally saying, look, it's better to take asset level dilution and get a share in that, and have someone else with much bigger pockets invest in the property. A favorite of both yours and mine is just I put into it, I'm underwater on it, and then it doesn't bother me, because I invested in the person and the array of projects he picked up. People like Chad Peters are phenomenal young guys that I want to support because if he's not worrying so much about always having to do the next raise, and whereas he can put his skill set to developing at the asset level, and he's got just such a innovative and a wonderful way of doing things and embracing. Like, I'm kind of an old guy for embracing Twitter the way I have, but he's at the generation that they get it probably, and probably just called me a boomer behind my back. But so Chad Peters at Ridgeline's another one. Yeah, Zach at Canoa Land. Oh, you're putting me on the spot now. There's two, and I'll try to give some more
Yeah,
thought.
I put you on the spot.
But we are a balding, gray-haired,
Yeah.
bespectacled kind of group of people. So it was very easy for the crypto crowd to kind of talk about drop gold, and and it's ancient, we're new. It's like, well, look at the spokespeople for the mining industry. They're as ancient as gold itself. So it's it's really good to see this youth movement coming into the space. I think we first saw it in a big way with what Brian Pace Braga did with Lithium X. And I think if you have these younger people talking to the very younger people that need to be the next generation of investors, I think they can relate more to people like Brian and Zach and Chad than they can people older than me. I'm not going to use me, but people older than me. And it's so we do kind of need to see that coming through.
Yeah, absolutely. And you're totally right. I mean, the average mining conference, the average age of the speakers is like 64, right? And so we do need to bring in that fresh, younger blood. We have a question. High grade. I think you know him, Doug. Go ahead and give Doug your question. High grade.
Hey, Doug, Merry Christmas.
Hey, Merry Christmas, buddy.
Just a quick question. In terms of the amendment process for Santana, could you just walk through the nuanced difference between getting the initial permit on Santana with respects to MIA and ETJ, and then the process involved in getting the amendment, which is in quotations the simple process?
Yeah, no, for sure. When first permitting, Mexico actually does permitting right. Like, you have to have your social license because you have to start with community agreements, surface rights agreements, typically with the local communities or ejidos. And that's in stark contrast to, say, Peru, where you see a lot of social issues that arise because a company won't approach social license. They know they can get the permits from the government, and then they'll deal with social license later. I think it's very important when you are going to develop a project in someone's backyard that they are really okay with that. And so you're kind of forced right from the start to have appropriate consultation and agreements in place with before you can even start the permitting process. Then the permit initially is two parts. There's an ETJ permit, which is the change of land use. From agricultural land, as it's largely class, to something commercial. And in the case of mining, obviously, in the case of us, it was a commercial gold mine. So you have the ETJ, and you also have the MIA, which is the equivalent. It's the environmental permit. It's where the heavy lifting is done, and the real meat of things is on the permit process. And there is some overlap between the two. And so historically, what we've always found, and our team's worked down there for the best part of 14 years, both applications go in for the two different permits. And typically, this is where we were surprised in the early days of the AMLO government, you get the ETJ, get the change of land use, there's a payment required at that point based on hectares and value of perceived value of the ground that goes into kind of a reforestation fund in Mexico, which I'm sure just goes into general corporate, government kitty. But so there's no bonds or anything like you see in Nevada. And then a period of time afterwards, typically it's been 45 to 60 days for our experience down there. The MIA falls, and it's because they've been both tracking largely at the same time, and there's a little bit more meat in the environmental permit. So I know when we got the ETJ for Santana, we got that around June 28th or 29th, 2019. And I asked Darren at the time, because I kind of wanted to be able to guide shareholders and investors alike as to when the MIA could come. He goes, well, typically it's 45 to 60 days, but we just don't know with this government. Could be 90, could be 120. So I remember at the time talking about expectations for October of 2019 for the MIA. And then out of nowhere, we just got notification third week of August, and the MIA dropped. And at that point, the ETJ and the MIA coalesce into one singular permit, the ETJ-MIA. And so with regard, so it's a much more complicated process when you are first applying for a mine, and amendments are typically much simpler. Because all that stuff, you're amending aspects of that initial permit, whether it be aspects of what originally constituted the MIA component or the ETJ, or a combination of both. And so we were anticipating in Q2 receipt of that, and it has dragged, like it has dragged for some other companies as well, and we're starting to see those come through. So we're with our amendments are of the permit that we have for Santana, which is the ETJ-MIA, and largely the amendments we're doing kind of are in the pages of that singular permit that are more MIA related now. And at last count, I believe the comment period, and credit to the government here, when you submit, they have 90 days to give you any response or comments or whatever. At no point did they run out the clock. We got comments back. We turned around and delivered responses and additional supporting information where was needed. That restarts the clock again to a maximum of 90 days. But in every case, it's been a very good, quick back and forth. There's just been a few too many back and forths, but a lot of dotting I's, crossing T's on stuff that we've never even been asked in our team's history down there, and that's fine. We have all the answers. So last I'm aware of, the comment period has run out the clock on those components related to the environmental part of the permit amendment. So there were some really minor things on the ETJ, but I'm happy to say that it seems like everything that we've delivered on the MIA aspects of our permit, the environmental aspects of our permit, have been accepted, and that we haven't received any more comments, and I don't believe we can receive any more comments now that we've gone through the structured 90-day comment period. So that's why I feel like we're on deck. I've been hearing these rumors down in Beaver Creek and Denver, few people referencing our name, and I was like, yeah, are you just conflating it because that we've got one in, or are you hearing ours is close? Because I'll take it, with a pinch of salt until we receive it, and hopefully it will be a pleasant surprise, just like it was in August with the original permit application, August of 2019, where it came as a surprise to us. But it's a number of people that I'm hearing it from, and from sources that make me feel like give me cause for optimism. Not hope, optimism. I mean, hope's not a good investment strategy, but these are the kinds of permits, these amendments that AMLO extolling why his government's been good for mining. He wants to. They're low-hanging fruit to some extent. There are the existing mines, and it's the difference between us basically getting Santana at a consistent, 5,000 ounces a quarter production, which doesn't seem like much, but in Q3 2022, where we produced just under 5,000 ounces, we spat off $3 million of free cash. So a 20,000 ounce annualized production rate at Santana, should spit off $10 million plus a year in free cash. It's like, that's a very nice ATM to have at a time where the market is starved for cash. We can be cash generating and reinvesting in the business, and we're hoping to be able to demonstrate that outcome is very much there for 2024 for our shareholders, hopefully as early into the new year as possible, because that would be the perfect way of kind of slamming the door on 2023.
Luis, do you have another question or comment?
Yeah, I just wanted to say one last thing, not to toot your horn, Doug, there, but since I got my Cap IQ up here, and since COVID, which was when you got Santana up and running, and you did that financing, you had 408 million shares out. You've got 460 now. That's 13%. That's a 4% compound dilution, which is pretty remarkable. And everyone knows I've got a big position in this company. I still hold it, and that's the reason why I still do, because you guys are doing it the right way. You didn't do damage to the balance sheet, and when you get these permits, you've preserved my ownership in the company by not diluting me as much as others in the space. So appreciate that.
Thanks, Luis. I mean, the thing I'd say is, I bought my shares like everyone else. I'm in the trenches. I do feel that the same pain, but I'm a big boy. I can take the short-term pain. It pains me more of our shareholders who've had a rough ride. But when you put close to $3 million of your own money into a company and built up a couple of percent stake in the company, there was no cheapies, no founder shares, which infuriate me when they're issued for no other reason than, hey, we're starting something, not because there's genuine sweat equity. It's amazing when you own a big stake in a company, how cognizant you are of dilution. And so it's something, I'm very proud of. It's nice to hear those numbers, Luis. I kind of always, just on a high level, think that that's pretty good. I see companies can dilute their shareholders by 40 or 50%, in 6 months. Very proud of our record there, but I think it's because we're big stakeholders in our own business, and something that investors should really, I think, look for in their management teams.
Yeah, that's an interesting. I was going to ask that question actually, and I guess I will ask it, Doug. When I think of CEOs buying, or CEO, chairman, president, executive level management in the junior mining sector who buy a lot of shares in the open market, I think of Dave Lotan, I think of you. How many shares do you own right now at this current time, and what's your rough average cost basis, if you know it offhand?
Well, I only know it because some shareholder who had way too much time on his hands calculated it. And I own 9.2 million shares, or the hair under that. So about 2% of the company. And I think my average cost is 27 cents. So, and people ask me, so the only way, yes, I'm slightly up, and I feel blessed in that regard, but slightly up. I see people create themselves millions of dollars of value out of creating paper out of thin air. I bought paper off someone else in our market, largely for our stock. So yeah, proud of that. And I was lucky. Great Bear has allowed me to accelerate some of those purchases, but I was doing it well before Great Bear. In fact, in many ways, I've always believed in any company I've been a director of, I bought in the open market. And in many ways, I'd be way better off now and be able to buy way more Minera now if while I was, building Minera up, I was fortunate enough to be a director of Great Bear, and I wasn't buying Great Bear stock. I did a little bit, but nowhere near the quantities I did with Minera. Money was going into Minera instead. But yeah, so I'm in a lucky position. I'm not expecting everyone's circumstances are different. I acknowledge that, but the reality is, I put $3 million in here that if I lost it tomorrow, it's meaningful nonetheless. And people have asked me, why, what's your game plan here, Doug? You've sometimes said that you don't want to be bought out. They're like, well, I don't think we should. And I take a point there and take a moment to say, buyouts, I know everyone craves them, but if we, to me, they're almost always going to ultimately feel like take unders. Like if we get Cerro de Oro up and running, Santana back to where it wants, and the kind of cash generation that business can deliver, and we've gone through all the hard work to do that. If someone's buying us out, they're not really buying us out because of the scale of our operations or whatever, but they are buying us out because of our cash generation. And why are they doing that? Probably because they need our cash. That doesn't sound like the kind of target company I want to own stock in, or have a very short-term type bounce in the stock, which ultimately disappears by the time the deal closes. For me, going through all this hard work, and for our shareholders going through all the pain and suffering of that hard work, the excitement is, from this base, what iteration of gold producer can we build organically? There, I think, is real value. And as a big shareholder, I want to have, we're very good in terms of our capital discipline. So I think if we were spitting off $30 or $40 million a year, like, there's no way Darren and I, with the way that we run things, could efficiently spend that capital. So I genuinely hope that there is a point in time where we can return capital to shareholders, and I would have to recuse myself from the decisions, but I would love nothing more than a dividend at some point. So when people ask me, why do you own so much stock? In many ways, it's something that my father, maybe subliminally, I picked up from him. He worked his whole life for an insurance firm, and to this day, the stock dividend that he gets from his shares he holds in that is worth a tremendous amount of money. And there is going to be a point in time where I want to kind of take a little bit more of a back seat from the day-to-day work side of things, and I can sacrifice my 120 grand salary to actually make more from the dividends that I can receive as a big shareholder of the company. So, and for people that hate dividends, it's like, and I get it, some people in some jurisdictions, they prefer buybacks. Buybacks don't hurt me so much, but I understand that. So, the goal here is to build a cash flow generating business where there's, let's just pick up an arbitrary number. If we can be generating $40 million a year, I'd want to see 20 million reinvested in the business and its growth. I'd want 10 million to sit on the balance sheet to, strengthen the balance sheet. And I'd like to see 10 million returned to shareholders, and if we have a good year and it's 45 million and there's an extra 5 that can be distributed to shareholders, maybe we have a hybrid of dividend and buybacks on that. But that's a goal. That's a vision. I've got to keep things firmly in the ground on where we are today, and say we've got to show Santana to be what it can be, and then get Cerro de Oro up and running. And I think then that environment for returning capital to shareholders is there and present, and it's not too far away. But first things first. But it's never going to stop me having a 1, 3, 5, 10-year plan for the company, and I'm excited to see where we can take it.
Okay, Doug, fantastic conversation. Thank you for all the time, all your insights. I think we're going to end it now, a little bit past the time slot that I allotted for this. On YouTube, I will upload this to my YouTube channel at Goldfinger Capital. You can find a lot of content there, including my weekly videos, and I have a lot of conversations with CEOs in the junior mining sector. So, Merry Christmas, Happy Holidays to everyone, and thanks again, Doug.
Yeah, thanks for having me on. Merry Christmas, and here's to a better 2024 for everyone investing in the mining space.
Cheers. Thank you.
Bye.